This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Beginning the show is Katelyn McCullock, Director of the Livestock Marketing Information Center, with this week's Cattle Market Update. She discusses trade data and LMIC's Cattle Feeding Returns Report. K-State's Jenny Ifft and Joe Parcell continue the show as they discuss the income outlook for Kansas agriculture. They say income is similar to last year, but operations income is probably not the same. Joe Gerken, K-State Fisheries and Aquatics Extension Specialist, completes the show by explaining how leaves can be beneficial or concerning for ponds depending on the quantity. That and more is coming up ahead on Agriculture Today. You're tuned in to Agriculture Today, and we start our Monday show with a cattle market update. And this week, we're joined with the director of the Livestock Marketing Information Center, Katelyn McCullock. Katelyn, thanks for joining us today.
Thanks for having me, Shelby.
Katelyn, as we start our discussion on the cattle market, first starting with the cash cattle market.
Well, the cash cattle market has seen a little bit of weakness in recent weeks. The 5-area price ended last week. Live steer FOB was 183.06. That was up a little bit from midweek, but it's been hanging in that low 180 range here for a little bit now. We would expect that to increase through the fourth quarter of this year, but we're really waiting to see what box beef does. If you look at what box beef has done historically, or at least in the last couple of weeks, a little bit of weakness, which is coming a little later than normal. Normally, we would expect to see holiday demand start by now, but really in the next 2 weeks, that's when we should really see this market come a little bit more alive. It's gone under that $3 range on the choice side, but really stayed close to it. And on Friday, we bounced back more than $4 from the day before and up to 302. So the more we start to see the cutout get legs under it with holiday buying starting to commence, the better that cash market on the fed cattle side is going to fare. Now, the opposite is sort of happening for the feeders. In Dodge City last week, we saw across the board a little bit of weakness, except for maybe those heavier weight cattle. 5 to 6s dropped, about $13 a hundred from the week before. This is that time of year where we see larger volumes come into the auction market, which is playing into that. So a little seasonal weakness. Still an outstanding price at $277 for 5 to 6 weights. The heavier weight cattle also saw a drop, $255 the week before, down to $252 on the steer side. And then for 8 to 9s, it was basically flat. So cattle feeders are indicating they still prefer those heavier weights to feed out. And some of that's due to kind of this feed price indication and where we've seen fed cattle prices go. On the futures market, it's been a little bit bumpy in the last week or so. Friday ended, live cattle trade was fairly strong, up over $1 for at least the 3 nearby contracts, October 2023, December 2023, and February 2024. Right now, 2024 contracts are still looking relatively strong, but they've come down from their peak highs that were set a few weeks ago. So April's trading at just under 194 at the close of last week. And that's down from a near $2 trade that was happening a few weeks ago.
And Katelyn, you mentioned the box beef cutout and kind of seasonal demand, and we talked a little bit about this before we started the interview, is grilling season is over, so the cuts of meat that are in demand are probably a little bit different now.
Yeah, with the changing of the seasons, we tend to think of people moving inside to cook dishes, no longer grilling outside. So that can look different for different people. But if you think about ground beef, we move those burgers off the grill and maybe put ground beef into things like lasagna or something like that. We also tend to see more oven roasted products come into play. And then there's, of course, holiday related demand as well. So parties and things like that, where you might be seeing more expensive cuts featured and things looking a little fancier maybe than your weeknight meal.
And moving on to talking about a recent trade report that came out, and on trade, first discussing some interesting things with imports.
So trade came out for the month of August last Friday, and the import side has probably been one of the more interesting things to watch. We really thought imports this year would pick up in a big way, and they've lagged where we thought they would be all year. And August really showed a change in that pattern. The total was up 24% 4% from the year before, and both Argentina and Australia shipped double what they shipped last year. So we're finally seeing those big increases that we were expecting. New Zealand very close to double what it was last August. Uruguay up 41%. Now that's just on the month. And so year to date, we're just barely starting to see imports creep above a year ago. So now they're up 5%. LMIC has revised this forecast. We think we're going to end the year, about 7% above a year ago. That was down quite a bit from where we started the year. And this indicates maybe I will move that forecast up a little bit to be a little bit higher. So far, the key destination shipping here to the U.S. is Argentina up 11%, Australia up 44% year to date, and then New Zealand up 30%. Uruguay up 22%, but a much smaller player in that market. And so very interesting to watch. I would expect the strength in these imports to continue. As we mentioned, boxed beef is at a very good price, and that might be enticing more product coming here to the U.S.
And is that price the reason that you think those countries have seen more imports?
I think the demand for the U.S. for lean beef is really strong, and we've enticed, I guess I should say, those countries to ship more here. And we would expect that in this type of environment. And we also, are producing quite a bit less beef than we were a year ago. The LMIC forecast is down about 5% for production year over year in 2023. And so we're using some of that beef to fill that void.
What did this report show for exports?
So exports are expected to be down this year after 2 record high years. And they are. Year to date, they're down about 14%, which is really close to in line with the LMIC forecast at this time. The big increases year to date so far have been Mexico and Hong Kong. Those are up 16 and 17%. And then all the major markets that we normally ship to are down. Canada's a brighter spot, about even with last year. We did see a little bit stronger drop in just the month of August. That was actually down 20% below last year. And across the board, almost all of our key export destinations were down. But Mexico really remains still a key strong market for the U.S. They still bought 17% more beef. And this is in line with what we see in terms of how their economic recovery is versus the U.S., North America, and the rest of the world. IMF has them pegged at doing quite well, especially relative to the U.S. in terms of growth prospects for the economy. And so that's really been a strong market for us almost all year or for the year.
And do you expect them then to continue to be a strong market as well?
I think they will be. The dynamic between the U.S. and Mexico is changing a little bit. We are seeing them not necessarily ship as many feeder cattle as they normally would be. Their cattle feeding on their side, on their domestic side, has really expanded. And so they're able to ship maybe more muscle cuts up here than they traditionally have. So we're shipping more slaughter-ready cattle down there as well. And so that we're in a process of maybe entering into a new relationship with them that hasn't quite found its footing. And they're also in a growth phase in terms of their economy. And so those two things combined, I think Mexico is going to continue to be a destination to watch evolve over the next several years and also keep an eye on from a trade perspective.
And Katelyn, there's another report that the LMIC has recently updated.
So the LMIC updated their cattle feeding returns for the month of September, and we saw that cattle feeders continue to do very well. So by our estimates, and this is a model, it's not a survey, and so it's built in, has some assumptions, but it's not necessarily anyone's actual returns. For feeding 750-pound steers for about 6 months, we have cattle feeders making over $300 a head. So a very strong return at this point. And that's really been the name of the game through most of 2023. We are expecting cattle feeders on our model test to return about $250 per head per month. So an average that's much higher than what they've seen in probably about maybe a little less than a decade. So a very good year on balance. However, we usually extend these estimates out about 6 months and do a projected break even. And one thing we've seen is that with that cattle feeder price that they're paying on the input side, those break evens have continued to climb. And so we are expecting in 2024 a substantial change in how cattle feeders are making money. So those returns are looking like they might be a lot closer to zero. They may be negative in some months. And so out through the first 6 months of 2024, it's a pretty different picture than what it was in 2023. Now, some of that is that so far the the futures board has not allowed those prices on the fed cattle side to get high enough to lock in the same type of profit levels that they saw this year. That can't say that, as we get into 2024, that those fed cattle prices can improve. But right now we have break evens, especially towards the second quarter of the year, looking more like in the 190s, which is quite a bit higher than they've ever been. So yes, the fed cattle price is high, but based on input costs, labor, interest rates, feed, and mostly those feeder cattle prices, that's what's really driving that break-even price a lot higher. And so it might be a pretty different environment out there in 2024 for cattle feeders.
And Katelyn, you mentioned this report from the Livestock Marketing Information Center, and a good time to mention that the Livestock Marketing Information Center is not all cattle reports.
Yes, we provide resources on hogs, sheep, dairy, corn, hay, and soybeans are some of the other markets that we cover.
So if people would like to go maybe look into those reports from LMIC, how can they do that?
Please visit our website at www.lmic.info, and there's some free content on the head page, which includes our livestock monitor that we put out twice a month. And then there's also some useful content you poke around in there, but it is a for-fee subscription. So most of our content is behind a paywall.
Katelyn, I appreciate you taking the time to join us today and give us our cattle market update this week.
Thanks, Shelby.
That was the director of the Livestock Marketing Information Center, Katelyn McCullock. If you'd like to see more from the Livestock Marketing Information Center, you can do so at www.lmic.info, which I will link that in today's show notes on agtoday.net. We're cutting to a short break now, but we'll be back with more ahead. You're tuned in to Agriculture Today, and we continue our Monday show with a discussion about Fall 2023 Kansas Farm Income Outlook. And to discuss this outlook, we're joined by K-State Flinchbaugh Agriculture Policy Chair Jenny Ifft and K-State Director of the Center for Risk Management, Joe Parcell. Jenny, Joe, thanks for joining us today.
Great to be here.
Thank you, Shelby.
Joe, this Fall 2023 Kansas Farm Income Outlook is done with the Rural and Farm Financial Policy Analysis Center. And so what is this center?
So we commonly refer to the center as RAF, so we'll be using that here the rest of the time we talk. And what the center is about is it's looking at state-level farm income, and this is the whole state farm-level income, and it's combined with our long-term outlook models that are used for policy analysis. And RAF was born out of a need that we don't have long-term state-level forecasts at the state level. We have national level. We have 1-2 year out from USDA, but we want to have longer term. So right now we're making forecasts in 23, 24, and USDA won't put out a Kansas state-level farm income until September of 24 for 23.
And important to make the distinction that Greg Eibendahl recently came on and talked, but he was talking specifically about Kansas Farm Management Association grain farms, but this is the scope of all agriculture.
Yes, these forecasts cover agriculture in the entire state of Kansas.
So now discussing that outlook, what are some global and national factors you take into consideration when putting this together?
Right. There's a lot of changes going on right now. So the USDA does expect corn production at the national level to rebound. We're going to probably see a slight decline in soybean production. Prices are softening up on the crop side across the board, so corn, wheat, and soybeans. Expenses have gone down as well. They did increase in 2022, but they've gone down. So that's reflected in the forecast. Now, for individual producers, the timing is going to matter quite a bit. On the cattle side, drought has reduced cattle numbers. So those are down, and that's really pushing up prices for both feeder cattle and fed cattle. Also, there is increased biofuel use of vegetable oil, so this is providing a little extra support for soybean prices.
And as we're talking about different crops, first looking at just Kansas crops, and the first one being hay.
Well, hay prices are still pretty strong this year. So the average last year was $172 per ton. This year it's estimated at $186 per ton. Again, this is an average. It can vary widely depending where you are on the quality of the hay. But hay prices are still strong, and there's a couple factors there. So some parts of the state are in continued drought. Other parts of the state have recovered, but their inventories or their stocks of hay had been depleted. So that comes into play as well. Although we do, if conditions continue, if yields get back to normal, we do expect prices to go down over the next couple of years.
And variability is always something used to describe Kansas and across the state for basically everything. And does that hold true also for corn?
Yeah, on the corn side of things, the variability is still there across Kansas, especially with the late season drought there on the production side, And the reality is we're dealing with lower prices this year than we had last year, and you combine that with a little uncertainty there on the production side. So that's going to help drive down some of that income or gross receipts from corn. I will say, Shelby, these numbers were based off the August of 23 USDA numbers. So we could see some updates yet, even in these numbers, as we get better and better information out of USDA.
Another important crop then to Kansas is also soybeans.
Soybean acres are down a little bit more than 500,000 acres. We've projected below average production and yield and lower prices, so we do expect soybean receipts to fall by about 0.5 billion or $50 million for 2023. So soybean revenue should be down a little bit this year.
Sounds like things are kind of looking down. And is that the same for then sorghum and wheat?
Yeah, you're basically looking at the same thing especially for wheat at least. And sorghum might be a little bit of a different story. And wheat, we're riding on the backs yet of the 2022 fall drought and the winter there. So we had quite a bit of variability there in production across Kansas. Some of the farmers were able to, go in and double crop with sorghum after that wheat. Maybe they ended that wheat season early. So, the outlook's still decent, at least on production for sorghum, but still, it trades in line with corn, and we're still got some depressed prices there in 23.
I know the crop insurance indemnities for wheat that was harvested this spring or early summer are higher than in 2022. So again, it's the effects of that drought.
And something that ties in with agriculture a lot in Kansas is cattle. And so how are cattle numbers looking for this outlook?
Yeah, the cattle numbers, they're following kind of the national trend right now. One is, of course, with the drought. Second of all, with the overall coming off a few years of higher grain and oilseed prices, we're seeing less cattle out there. And what we see in response to that is some higher prices. So especially, big factor here in Kansas is the feed yards. And so they're paying higher values for those calves, and they're hoping to get that higher value on the feds when they come out of this. And kind of right in the middle of that right now, we're bringing in some expensive feeders right now, but hopefully starting in 24, we'll be sending some high-valued feds off to market, and that's helping drive the income now. But it's we still got some higher grain prices, so it's still costing a lot to get those cattle through the feed yard.
And another species that isn't quite as abundant as cattle, but still important to Kansas, hogs.
Yeah, I'll take hogs. I'll tell you, hogs is one of the outliers in all this. They're dealing with some higher grain prices, feed costs, but also they haven't seen the strong prices either. Especially if you look at the late 22, early 23, which is 23 is this based off of. So, that is a segment of agriculture that's, still probably seeing still needs to be on the rebound a little bit.
And a few more species to talk about for Kansas. We have dairy, poultry, and their eggs.
So on aggregate, we don't expect to see much of a change in receipts from 22 to 23 for those sectors. And we do have a growing dairy sector in Kansas that we're following.
And all of these come together to obviously create expenses. And one expense that we've talked a lot about these past few years is fertilizer.
Yeah, on the fertilizer side, we saw record high prices here in 22, fall of 21 into 22's crop production year. Into 23, we see the prices softening. Everybody's got their eye on fertilizer, especially as we look towards 24. But fortunately, we had a decline in those fertilizer costs and helping us drive down the input costs, which helped offset some of the drop in receipts, at least on the crop side of things.
And fertilizer is a big line item for expenses, however, not the only one. And so overall, how have total production expenses looked?
Yeah, in this particular model, Shelby, we're down about $2 billion in production expenses year over year. And again, most of that is driven by the fertilizer because there has been a few increases in there, but the fertilizer offsets that and drives down overall expenses, at least on the crop side of things.
So as we've talked about the different income and expenses, what does the fall 2023 Kansas farm income outlook look like?
So we're expecting $4 billion of income across the entire state. That's almost the same as the previous year. It's about $4 billion in 2022. So on aggregate, it's the same, but within sectors, there's a lot of variability. Livestock receipts are up, crop receipts are down. Also, where you are in the state matters. In South Central Kansas, Southeast Kansas, they're in their second year of extreme or exceptional drought, and that's a part of the state where you usually don't see it. So they're really suffering there. The Southwest, Northwest, a lot of those counties are out of drought after suffering from 2 years. So depending when you got rain, I've heard some stories about how, one part of the county got rain, one part didn't. So where you are in the state, when you got precipitation, when you bought your expenses is going to matter a lot for individual farms and ranches.
Joe, as the director of the Center for Risk Management, how do producers maybe want to take this into account when thinking about how to mitigate risk?
Yeah, great question, Shelby. So, there's a couple angles on this. And, one is on the price risk side. You can never underestimate, and really it's outside of the individual producer's control, what these markets are going to do. So you're always going to look to, the futures market or contracts there. More and more so, even on the production side, there's going to be a lot of decisions made right now about what to do for inputs for next year in there. And, especially on the fertilizer side, that's the big question right now. Should we buy now or should we wait? And, what we can do is we can look at the past a little bit to tell us about the future. And we know we're down from 2022, but, maybe we'll stay that way. So, and then the third thing, we talked about the crop insurance there, as we look at livestock revenue coverage and stuff, and hay insurance.
Yeah,
right?
PRF already had $31 million in indemnities for 2023. So
yeah.
It'll be pretty big payouts this year.
I mean, we can't underestimate the value to producers right now or the industry of taking out that insurance.
For people who'd like to read more on this report, where can they find it?
Yeah, Shelby, they can go to Rural and Farm Finance. That's all one word, .com. ruleandfarmfinance.com.
Joe, Jenny, I appreciate you both taking the time to join us today and share with us some information about this Kansas Farm Income Outlook.
Great to be here.
Thank you.
That was Director of the Center for Risk Management at K-State, Joe Parcell, and he was joined by K-State Flinchbaugh Agricultural Policy Chair, Jenny Ifft. You can find this report by going to ruleandfarmfinance.com. I will link that web address in today's show notes, which you can find on agtoday.net. And as always, if you're reaching your destination and don't want to miss out on the rest of today's show, you can also find the full show and past shows on agtoday.net. We're now cutting to a short break on Agriculture Today, but when we come back, we'll be joined by K-State Fisheries and Aquatics Extension Specialist Joe Gerken with this week's information from K-State's Wildlife Department. You're tuned in to Agriculture Today, and we wrap up our Monday show with information from the Wildlife Department here at K-State. And today we're joined with K-State Fisheries and Aquatic Extension Specialist Joe Gerken. Joe, thanks for joining us today.
Thanks for having me back.
Joe, you wanted to talk about leaves being in ponds.
Yeah, it hasn't seemed like it this year because it's been so warm, but we're finally officially into autumn, and so the leaves are going to start to fall off those trees. A lot of times they fall into our ponds, and there are some benefits and some drawbacks from leaves in our ponds, so I thought we'd discuss that a little bit today.
And so what are some of those benefits of leaves being in ponds?
Sure. So leaves are taking nutrients from that photosynthesis and they're adding it to our ponds. And so if we're adding a few leaves, that's a great thing. A lot of bugs need those leaves. There are a lot of bugs that, chop up the leaves. There are a lot of bugs that will eat the bacterial colonies that grow on the leaves. And when we talk about ponds, we think about bugs. No one's really interested in bugs, or most people aren't. But those bugs form the base of our food web in the pond. And so having something that those bugs can grow on can be really beneficial to the fish in our pond, or just the overall health of our pond in general.
So a lot of times leaves are a good thing. However, every once in a while they can be a concern.
Yeah, so leaves are a good thing in the right number, but just like life, moderation is key. And so we want to make sure that there are some leaves that are beneficial, but too many leaves can be a problem. And one of the big things that we start to see when we get too many leaves is they stack on top of each other. And oxygen's really only on the top level of those leaves. And so if there's no oxygen, it tends to not break down. The bacteria can't break down those leaves. And so you end up with situations where the leaves break down really slowly and they turn into pond muck or pond sludge. And we've talked about that before, how that's not really a great thing. So if you walk out in your pond and it's really, really squishy, really dark, or a little bit smelly, that sediment itself, that might be an indication that some of those leaves have built up too much over time.
For people who are seeing those indications out in their pond, if it's a small pond, what could they possibly do?
Sure. So if it's a small pond, taking a rake and going out and cleaning up some of those leaves, taking them out of your pond would be a great idea. Or if there's, areas of a bigger pond where you're getting a high concentration of leaves, you might be able to go out with a rake and take out some of those leaves that are accumulating. Obviously, if you have a big agriculture pond, we're talking acres in size, it might not be realistic to get all of the leaves out of that pond. And so, mitigating some of the issues, helping to make sure that we have oxygen throughout the entire pond, things like aeration might come to mind that can be beneficial. But really, if we're talking about a bigger pond, we might need to go to the source and talk about how to manage some of those trees themselves.
While drought has not been a good thing for agriculture this year, there is an opportunity when it comes to leaves and ponds.
Sure. So if your pond has been built up over time, if it's filled in with some of this sediment, one of the big advantages of having a drought, it's hard to say an advantage with a drought given all the hardships it's caused, but it is an opportunity to go out and clean up the ponds to some degree. So get out there, dig them out while they're dry. It's a lot easier to do, a lot cheaper if you have to hire someone. It's a really good opportunity to get out there and clean up some of those issues. It's also a good time to go out and maybe think about, do you want to cut back the number of trees that you have or do some mitigating opportunities on the pond itself to help cut back on the number of leaves that are entering our ponds.
For people who are maybe wanting to put trees around their pond or are wondering what trees need to go around their pond, what are a few tips you have there? Sure.
The big thing that we want to think about is trees on a dam is generally a bad idea. So the roots can dig down into the pond. It can cause some leakage issues over time or lead to complete degradation of the dam. So if you have small trees that are growing on your dam itself, you'll want to make sure you go in and you cut those off and treat them with an aquatic safe herbicide to make sure they don't grow back. If you have established trees on your dam, that gets a little bit trickier. So those roots are already there. You might want to remove them and you might not want to remove them. So that's when you'd want to talk to a professional, reach out to your local extension agent or reach out to me, and we could help figure out how do we manage those trees to best benefit your pond.
Joe, I appreciate you taking the time to join us today and share with us some information that producers might want to think about with leaves in their ponds.
Thanks for having me.
That was Kansas State University Fisheries and Aquatics Extension Specialist Joe Gerken. That's all we have for you this Monday on Agriculture Today, but we'll be back with more for you tomorrow.